You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to another Profit from the Pros. I'm Terry Ruffalo. The start of fourth quarter earnings season. Inflation data and European sovereign debt issues were all the main focus of investors this week. There was some early optimism related to fourth quarter earnings, while reports of Japan's willingness to follow China in buying European debt and Portugal's success at raising money in bond sales helped ease concerns over debt woes overseas. Successful bond auctions in Spain and Italy also helped sentiment as well. U.S. economic data mixed, with December producer and consumer prices ticking up from November. Weekly jobless claims up in the latest reporting week. But the U.S. trade deficit narrowed for the third straight month in November, although the gap with China did rebound. And December retail sales rose slightly, marking the sixth straight monthly increase for retail sales. And it was also reported on Friday that business inventories grew a much less than expected in the month of November. So with all of that having been said, let's bring in Research Director Shiraz Mian now to share some of his thoughts with us on what's going on. Markets since the beginning of 2011 here been essentially flat, hasn't it?
Yes, it has been, and that's not a bad thing. The extent of gains that we have had in the second half of 2010, particularly in the last quarter of 2010 and coming into 2011, were so quick and in such a rapid succession that many of us were wondering if the market will have an opportunity to consolidate those gains before moving up. So this phase where the market is not really making a clear move up from those gains is, in my view, a positive that the market is consolidating and stabilizing around those gains.
So if it's going to move significantly, it probably now will wait till after earnings season?
I think a certain level of earnings growth is already factored into the market. Remember that we have had the earnings scene has been one of the standout metrics in this recovery. Yep. So the market has become used to expecting this quarter after quarter of strong earnings. I don't think the market will behave positively or negatively in any meaningful way in this earnings season. I think the key number and the key metric for the market remains the broader economy, and particularly the labor market. For trend changing move in the market, for a breakout move in the market, we need to see stable, viable, sustainable improvement in the labor market. Until we don't see that, I'm not really looking for significant gains in the market. Okay,
but overall, your look for 2011 still remains positive. Share with us some weekend wisdom, if you would, on a couple of the main reasons why you're positive.
Three main reasons, Terry. The primary is the broader economy. As you would recall, it remained a major obsession in 2010 for the market, whether the economy is getting back into another recession or not, whether we are going into a Japan-like scenario of deflation coupled with no growth or low growth. And those issues remained with us through the first 7-8 months of the year. So those fears have subsided. The economy came back in the later half. The Fed was very proactive. The Congress and the administration helped the process along. So the outlook has been steadily improving. We see estimates for GDP for the fourth quarter as well as 2011 and 12 improving. The second most important, as you alluded to, was earnings. Earnings has been a standout element. When all is said and done on the fourth quarter, we should have north of 45% growth in 2010. Another 15-20% growth is expected for 2011. So very strong earnings momentum in the corporate sector. Balance sheets are in excellent shape. And my sense is that we are at the beginning of a virtuous investment-led cycle in the economy. economy, and there's evidence that the labor market and some of the other holdout areas in the economy are also coming along. So overall, these elements make me very comfortable with a positive outlook for 2011, much better than what we had in 2010.
Give me a couple of standout industries that you think are going to perform well.
I think these will be cyclical leverage to a recovering U.S. and global economy. The standouts would be finance, the standouts would be industrials, technology, as was the case in 2010 as well, energy and consumer discretionary. Consumer discretionary and finance could come as a little bit of surprising to folks, but we see improvement in the consumer economy, in the labor market, and that should drive gains in that sector.
Okay, bull and bear stocks still ahead. Stay with us. Here is your bull and bear stock of the week. A coal company and a specialty retailer make up this week's bull and bear of the week. Shiraz Mian back with us again to discuss both of these in a little more detail. Now, the coal company is Natural Resource Partners Limited Partnership, NRP, the ticker, on the New York. What makes this a bull?
You mentioned the main reason why it is the bull. It's a coal producer. More specifically, Natural Resource Partners is not itself a miner, a producer of coal. It's a master limited partnership, meaning that it owns the leaseholds of the miners and the mines and the assets from which then other operators are extracting coal. So it's an even better play on the improving outlook for coal than a pure play coal producer. You don't even have to dirty your hands with coal in benefiting from it. And the coal outlook is steadily improving. The improving global economy, U.S., the China story, supply constraints, all of those had been pushing up the price of coal ahead of time. And then we had these serious floods in Australia, and that has further put pressure on the supply chain, particularly to the Asian market, and that's showing up in coal prices. On top of that, Natural Resource Partners, as is the case with all MLPs, has a pretty good, decent, juicy distribution, which we normally call as dividend, in the 5.5%, 6% yield range. So that's a pretty decent positive attribute for NRP as well.
Okay, and yeah, that flooding in Australia driving prices higher is what you meant.
It is. That's right. So it's it appears to be a short term, but I'm reading some analysts talking about this seriously damaging the supply picture down under. So it could be a problem.
All right. Specialty retailer is Kirkland's, K-I-R-K, ticker symbol on the NASDAQ. So why is this a bear?
Kirkland's has had problems for a number of years now. And relative to other retailers, specialty retailers, they entered the downturn in a relatively weaker shape than some of their peers. The retail space in general, Kirkland's is more on the home decor, home furnishing end of the business, then further gets weakened because of the issues that we have on the housing side. So retail is weak because the labor picture is weak. On top of that, a double whammy for somebody like Kirkland's is the weak housing picture, and relative to some of the peers like Pier 1, Williams-Sonoma, they entered the downturn coming off of a major restructuring. So they have issues in their margins, in their merchandising, in their mix. It's showing up in constantly shrinking and under pressure margins, and the estimates are coming down. We saw that in two back-to-back quarterly misses with Kirkland's, and I don't think that trend is reversing anytime soon.
And quickly, they have an ever-changing merchandise mix.
They have to.
Doesn't help.
That's right. That's right.
Okay. Thanks for that. We appreciate you taking all the time to be with us all through the program. You will be with us back at the round table. You want to stay tuned for that. We are going to be screening, stock screening. Yeah, that's right. Haven't done that in a while. That's next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This week we are talking about a broker triple play, whatever that means, with Kevin Matras, who is our top stock screener. And he's going to fill us in. Now, I have to admit, by just reading that phrase, it sounds like something coming out of a baseball game, but this is football season. There's snow on the ground. So what you talking about, Kevin?
Well, in spite of the baseball reference, there is zero reference to baseball
in the piece?
Right, in this at all. No, actually, if I were to look at it, there are three distinct broker inputs. So I guess there's the triple play part, just for the record.
I see.
Either way, the title aside, what I wanted to do with the brand new year upon us is I wanted to kind of get an idea as to what the brokers were saying and what they were paying attention to. So I just decided to build a top-down broker screen, and this is what we're going to be talking about today.
Cool. Let's get right to it.
Yeah, the first thing I wanted to do was I wanted to isolate what the brokers thought were the top sectors. So here we go.
All right.
First item is the average broker rating. And we're looking at the best 8 sectors with the lowest average broker rating. So I picked the best 8 sectors since that represents half of the sectors in our universe. So we've got the top 50% of sectors, best 50%. And we specify the lowest average broker rating because, of course, the lower the rating, the better.
Got it.
So then the next item is I wanted to be able to see the stocks getting the best broker rating upgrade. So that's the next item. So we want the percent broker rating change over the last 4 weeks, and we are looking at the 10 stocks within each sector.
Okay.
This item selects the top stocks with the biggest broker rating upgrade over the last 4 weeks. And since we said top 10 stocks in each sector, that means we're going to have as many as 80 stocks at this point in the screen. Now, the reason why this is interesting, and it's probably not surprising, but in our testing we have found that companies that receive broker rating upgrades do far superior than companies that don't get upgrades, and they outperform even more so companies that get downgraded. So this is going to help us find those kinds of companies by using this item in the screen. Okay?
All right, sure.
Then I wanted to find the companies that had the highest earnings estimate revision. So here's the third item in the screen. We're looking at F1 earnings estimate revisions for the last 1 week and 4 weeks combined. And we are then saying, show us the 30 best stocks of those 80 that had come through previously. Once again, for this one, we want the companies with the highest combined total, looking at the 1 week and the 4 weeks. And again, with earnings season now starting, I believe it started with Alcoa on Monday, I think this is a very appropriate screen to look at. Plus two, if you see that a company is getting their earnings estimate revised right before they are ready to report, that's a fantastic thing, and it really shows the analysts have a lot of confidence in the company. And plus two, when you also come to realize that earnings estimate revisions are the most important thing affecting stock prices, it makes even more sense.
Give me a couple of stocks that came through.
Yeah, of course there were 30. Here's 5 of them. We've got BE Aerospace, Danaher Corp, Knoll, Smurfit Stone, and Sunoco Products. All of these companies are in top-rated sectors. They have upgraded broker ratings and increased earnings estimates. There's the triple play.
All right, you're at the round table with us next. Don't go away, and don't you either. We'll be right back. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. This is one of those weeks where there's just so much to talk about. We're just going to get right into it here with Shiraz Meehan, our research director, Kevin Matras, top market technician, and Tracy Reinick joins the roundtable again this week. She's one of our equity strategists here, so welcome, Tracy. It's nice to see you sitting down there. So nice. I'm going to start with you.
Okay.
Everybody's like, oh no, who's he going to start with this week? So another earnings season is upon us, and companies, they've been producing some strong double-digit earnings gains on the back of only single-digit revenue growth. How long can that go on?
Well, this quarter it's going to keep going on. We know it's not going to continue for forever because we're starting to see, some impact on the year-over-year comparisons now, and that's going to get harder to do as the year goes on. But for this fourth quarter, and probably going into this first quarter, I think it's going to be pretty good.
Okay, so revenue growth is still a big issue here, though, right? Going forward,
it is, but it's not as big an issue as it was earlier in the recovery. At the beginning of the recovery, when we started having this earnings momentum, late 2009.
Yeah.
The growth was primarily from margin expansion, essentially meaning squeezing more costs out of the system. We did that for 3-4 quarters. Then we started seeing some top line life. In the last 2-3 quarters, we have been seeing 4-5% top line growth. So it's been a combination of revenue growth at the top, continued margin expansion at the bottom, driving earnings forward. And my sense is that the extent of the margin expansion is no longer going to be comparable to what we have had in the past. But I think there's still room to go. I think in 2011 we will still have some margin expansion.
Well, if the numbers come in as they're expected for fourth quarter, Kevin, this earnings season could notch the highest fourth quarter earnings season per share in history. So is that telling us then that investors, and given what the market has been doing lately, end of 2009 going in, or end of 2010 going into 11, are investors now still confident in the economic recovery?
Yeah, I think they are. First off, I took a look at how many companies had reported in the S&P so far. Only a handful of companies, a handful of companies in the S&P have thus far reported, but 75% of those companies that have reported a positive earnings surprise.
Right.
About the same percentage of companies have reported a positive sales surprise. And what's interesting is that the beats have been way higher than the misses. But yeah, I do believe that that with the economic recovery taking hold, with a lot of great things happening, granted, the recovery is still moving a lot slower than what people would like to see. Mm-hmm. But I really do believe you're going to see corporate profits continue to set record highs, and I think that we have a whole new wave of growth coming in 2011.
So given what he just said, Tracy, we saw this week the numbers show that inflation ticked up a bit, both on the producer side and on the consumer side. But was it enough to be a game changer at this point?
Well, not yet, because they're stripping out, food and energy, and that's where the big...
Yeah, which I can't understand.
I know.
For the life of it. Yeah, right.
I mean, just last month alone, gasoline prices were up 8.5%, and, they're like down the street from me here in Chicago, the gas is like $3.60 a gallon, and everyone is already predicting the $4. Once you get up to those levels, it's going to impact everything else. But the Fed isn't going to make its decisions just on gasoline and food. Yeah. But at some point, those factors will play into it.
So then is Shiraz's sovereign debt issues still the main headwind here for the market?
I think it does. I think it remains kind of a lingering issue that remains out there for the market to get worried and concerned about every now and then. We have some major funding problems coming through, or funding needs coming through, between now and the middle of the year for Portugal as well as Spain. Spain is the main issue. If we get through the first half of this year with Spain easily meeting its funding needs, I think we would be in the clear. Overall, I think it remains an issue, but the problem remains contained to Europe. It doesn't drag us down.
Kevin?
Yeah, what I was going to say is that, yeah, it is true that you are seeing inflation increase. But, yeah, when you look at the core, it's much more modest than the headline. But I think the proper way to look at these numbers right now is that, what the Fed is doing, it's working. They are trying to fight deflation, and we are not seeing things deflate. We're seeing things inflate. And right now, even if you look at the headline with 1.1%, the Fed's stated inflation target is 1.7. So we are well below there, and I don't think we're going to even approach that for at least another year or so.
Is deflation even an issue right now? Because it hasn't been talked about in a while. Right. Do you consider it to be an issue, Shiraz?
It's less of an issue than it was in the middle of 2010. I think we are coming out of that fear that gripped us and kept us riveted to that scenario. If we see more inflation, as you mentioned in the CPI, PPI data, I think that shows, as Kevin was saying, that what the Fed is trying to do is working. Right. The Fed is trying to re-inflate the U.S. economy, and if we see positive inflationary numbers, that's a good thing.
Okay, quickly give us your top stock pick.
The commodity complex, particularly agriculture commodities, it's on fire, literally. My pick is a play on that. It's the Mosaic company. It's a fertilizer producer. But each time when farmers' incomes increase, they use more of this, and Mosaic remains well positioned to benefit from that trend.
Okay, Mosaic, a hot picture. Kevin?
I do like ag a lot as well. My pick is FedEx, ticker FDX. They are a global transportation air freight company. What I like about them right now is that they have a 30% projected growth rate for each of the next 2 years out. But what I had just seen, I think last week, is that they have created new cargo routes between India and China. Their growth is expanding, and I think this is going to be a catalyst for a big move in FedEx.
All right, Trace Nader.
I have Ancestry.com, which is an online genealogy company. Kind of interesting. You can go on there, find all these records from your ancestors. They have monthly and yearly subscribers. Their subscriptions are increasing. They're a little pricey here at like 32 times, but they have big earnings growth this year, expected about 50%, next year about 40%. So the projections look good for this kind of company.
Yeah, it makes you wonder how they get all that information on people, doesn't it?
Yeah,
I know.
the government,
like
they're
firewalls
downloading
built
it.
all
Yeah.
around
Yeah.
my statistics. Thank you all for being here with us, and thank you for being with us as well. Hope the week ahead's profitable for you, and we'll see you next time here on Profit from the Pros.